Ah, sorry about that. I have slept since 12 o'clock to 16 o'clock after that. Uh, should happen. Um, I have slept. My bad. Okay. I need to have this a bit so I didn't have my eyes. Yeah, I was thinking about playing my music, but like, nah. Okay. I'm just gonna play this rap music. It's really good. I recommend it. I don't know who made this. I don't know how did you find this music. The chill girl vibes. Yeah, banger song. Banger song. I don't know who this is. This artist is. I Yes, probably it's like indie artist, like small artist. Banger. Okay. I want to come back to studying. Let's go. I bought my coffee. I've stared at the wall for like 10 minutes. That's the reason why I stared at the wall for like 10 minutes. Because I need to reset my brain to do stuff. So yeah, let's just start studying. Last time I learned 2A, which is about balance sheet and inventory. Analyzing balance sheet. Next one, we're gonna analyze like our analysis of inventory. Um, okay, let's start now. There is 70 slide. Okay. LIFO and FIFO, that's what I learned. I'm gonna start like some random stuff that I like. So let's start with that. LIFO, and I know about this. Let's see. Okay. So I'm going to start this. Thank you, accounting stuff. I love you. Good channel. Is my tradaras? No. 47 minutes. Oh, there's FIFO and there's LIFO. There's two video about this.
In this video, we're going to cover an inventory cost flow assumption, FIFO, which means first in, first out. Hey there, my name's James, you're watching Accounting Stuff, and today we're continuing our How to Account for Inventory mini-series. It's got a better name for it than that. So far we've covered cost of goods sold and the perpetual and periodic inventory systems. If you missed either of those, you can find them linked up here and down there in the description. Today we're moving on to another hotly requested topic, inventory cost flow assumptions. By the way, if you hear any squawking, there's a really noisy crow out there. I've tried telling it to be quiet, but it won't listen to me. Anyway, there are three inventory cost flow assumptions that you should be aware of: FIFO, LIFO, and AVCO. In this video, we'll be doing FIFO. I'm going to show you a four-step process to calculate cost of goods sold and closing inventory using this method. So let's get into it. When do we need inventory cost flow assumptions? Let's think back to our inventory calculation from the previous video. Opening inventory plus additions gives us cost of goods available for sale. And when we subtract our cost of goods sold from this, we get our closing inventory.
I think we're gonna start with this.
Hello there,
so-
and welcome back to Accounting. I'm James, and today I'll teach you almost everything that you need to know about inventory in accounting. This special compilation video is split into 5 parts. First, I'll give you a general overview of how we account for inventory. I'll show you how it's linked to cost of goods sold and the journal entries. Then we'll cover inventory systems, both the periodic system and the perpetual system. And then we'll go over 3 inventory cost flow assumptions: FIFO, LIFO, and AFCO. Make sure you watch this right the way through to the end to give yourself a full understanding of how inventory works.
I don't. I think I'm a little bit AFCO.
Main types of business that hold
So yeah, definitely in this video.
Merchandising businesses. Manufacturing businesses buy raw materials which they make into finished goods that they then sell to earn revenue. Whereas merchandising businesses do things slightly differently. They buy goods that they resell to earn revenue. Okay, so with that in mind, what is inventory? Well, in manufacturing business, inventory is the raw materials, work in progress, and finished goods held by a business that it intends to sell to earn revenue. However, in a merchandising business, inventory is the goods held by the business. So you see, the definition for inventory in a merchandising business is a bit simpler. Manufacturing businesses hold 3 different types of inventory: raw materials, work in progress, and finished goods. Whereas merchandising businesses only have one type of inventory: goods. For a good to be treated as inventory, a merchandising business must hold onto it, and it must plan to sell it in the future in order to earn revenue. This future economic benefit is the characteristic that makes inventory an asset. Actually, inventory is normally thought of as a current asset because most businesses intend to turn their inventory into cash within 1 year. But more on that soon. Let's imagine that you own a merchandising business. You buy your inventory from a supplier, and then you sell this inventory on to your end customer. Sell what? Hats. Actually, since I'm in Canada and winter's just around the corner, let's do toques instead. So you run a merchandising business that sells toques. You buy your toques from your local manufacturer at $4 a toque, which you pay for in cash. You sell these toques on to your end customers at $7 a toque. Your customers pay you on account. How do you account for this? Well, for each toque that you sell, there are 2 transactions to consider. Transaction 1 takes place when you buy the toque from your supplier, and transaction 2 happens when you sell that toque on to your end customer. To record these transactions, you'll need to create some journal entries. So what's the journal entry for transaction 1? You bought a toque from your supplier for $4, so you need to debit your inventory account to increase it by $4. You debit inventory because inventory is a type of asset, the A in dealer, which makes it a normal debit account. So debits increase it and credits decrease it. If you haven't heard of dealer before, it's a handy acronym that you can use to identify debit and credit accounts. I made a video explaining what it is in more detail, which you can find up here. Okay, now where does the other side of this journal entry go? You've bought something, so you have 2 options. You could credit cash, or you could credit accounts payable. In this example, you paid for the toque in cash, so you credit your cash account to decrease it by $4. Cash is another kind of asset, the A in dealer, which makes it a normal debit account, so you credit cash to decrease it. Great, so here's your completed journal entry for transaction 1. Debit inventory by $4 and credit cash by $4. But how does this journal entry affect?
Wait, before that, I forgot. Debit is entry, right? Generally, okay.
Well, we can find that out using T accounts. T accounts help us visualize the impact of transactions on your general ledger. This journal entry affects 2 T accounts: cash and inventory. These are both assets which are held in your business's balance sheet. In T accounts, debits always go on the left and credits always go on the right. So you debit the left-hand side of your inventory T account by $4 and credit the right-hand side of your cash T account by $4. Okay, I'm afraid that was the easy part. In transaction 2, things become a little more complicated. We need 2 journal entries to record this transaction. Oh, and if you're finding it hard to remember all of this, I put together a 1-page cheat sheet that summarizes all of the key areas in this video. You can help support this channel by buying it on my website. There's a link to it up here. In transaction 2, you need to recognize your revenue and record your cost of goods sold. To recognize your revenue, you need to credit your revenue account by $7 to increase it in your income statement. Revenue is the R in dealer, a normal credit account. Is your revenue, you need to credit your revenue here. In transaction 2, you need to recognize your revenue and record your cost of goods sold. To recognize your revenue, you need to credit your revenue account by $7 to increase it in your income statement. Revenue is the R in dealer, a normal credit account, so credits increase it and debits decrease it. To increase it in your income statement, revenue is the R in dealer, a normal credit account, so credits increase it and debits decrease it. But where does the other side go? Well, you've sold something, so that means you need to debit cash or accounts receivable. In this example, the customer paid you on account.
Fuck.
That's like an IOU. They haven't actually paid you the money yet. That means you need to debit accounts receivable to recognize that you're owed $7. Ooh, hold on to your horses. We've got one more journal entry to do. You need to release the cost of goods sold from your balance sheet to your income statement. Here's what I mean by that. In transaction 1, you took up $4 of inventory in your balance sheet. This is your cost of goods. When you sell the toque to your customer, you'll need to release this cost of goods from your balance sheet to your income statement. But how do you do that? Well, you credit your inventory account by $4 to decrease it in your balance sheet, and you debit your cost of goods sold account by $4 to increase it in your income statement. Cost of goods sold is a type of expense, the E in dealer, a normal debit account, so debits increase it and credits decrease it. Nice one, so we've worked out both of your transaction 2 journal entries. But how do these affect your books? We're going to need some more T accounts. 3 more, because as well as affecting cash and inventory, these entries hit accounts receivable in your balance sheet, along with revenue and cost of goods sold in your income statement. To recognize your revenue, you debited accounts receivable by $7 and credited revenue by $7. And to release your inventory or your cost of goods sold from your balance sheet, you credited inventory by $4 and debited cost of goods sold by $4. What's nice about T accounts is that we can easily see the impact of these transactions on your books. You're left with negative cash of $4, an increase of $7 in accounts receivable is that we can easily see the impact of these transactions on your books. You're left with negative cash of $4.
Negative cash?
An increase of $7 in accounts receivable.
Oh, because we haven't got the cash yet, right? Because, yeah,
and a net movement of nil in your inventory account.
Yeah.
You also earned $7 of revenue and incurred $4 of cost of goods
revenue and
sold. These 5 key accounts make up a small section of your business's books, which in turn are used to build financial statements like your balance sheet and your income statement. The balance sheet gives you a snapshot of your assets, liabilities, and equity at a single point in time, whereas the income statement summarizes your revenues and expenses over a period of time. So now let's recap what went down a few moments ago, but this time
oh my god.
in front of us. In transaction 1, you bought a toque from your supplier. You converted $4 of cash in your balance sheet into another type of asset, inventory. At this point, you're down $4 in cash and you're holding $4 of inventory in your balance sheet. Then, in transaction 2, you sold the toque on to a customer. This transaction impacted both your balance sheet and your income statement because you released this inventory from your balance sheet to cost of goods sold in your income statement. And at the same time, you recognized $7 of revenue in your income statement and increased your accounts receivable in the balance sheet by $7 as well. That leaves you with negative $4 of cash and $7 of accounts receivable in your balance sheet.
Asset 3, liabilities and equity.
Profit of $3. Okay, so now you know how to account for 1 unit of inventory. But how do you do this for many units at the same time? We use inventory systems, the periodic system or the perpetual system. Before we jump in, you should know that I put together some inventory cheat sheets covering everything that I mentioned in this video. I'll leave links to them down in the description. So how do inventory systems work? In a merchandising business, inventory is the goods held by business that it intends to sell to earn revenue. A perpetual system.
I need to fucking go to the toilet. Fuck. Back.
Continuously updates a business's inventory account as goods are bought and sold on a unit-by-unit basis, whereas a periodic system updates a business's inventory that I mentioned in this video. I'll leave links to them down in the description. So how do inventory systems work? In a merchandising business, inventory is the goods held by business that it intends to sell to earn revenue. A perpetual system continuously updates a business's inventory account as goods are bought and sold on a unit-by-unit basis, whereas a periodic system updates a business's inventory account at regular intervals. This is usually triggered by
I'm
a business
killing you, bro.
that happens at the end of each accounting period. It could happen after each month, quarter, or at the end of a financial year. So, what are the pros and cons of the perpetual and periodic inventory systems?
Perpetual is gonna be harder.
The system continuously updates your books, which means, in theory, that it's possible to see your results in real time. This system also makes it easy to track your inventory levels so you can spot stock shortages quickly. Sounds great, doesn't it? Yes, but this comes at a price. It can be expensive to set up a perpetual inventory system, and it's not always reliable. You can sometimes find differences between inventory levels in the system and what they are in real life. Some of your inventory might have been lost or stolen, or there could be some human error involved. Who knows? Who knows? But this uncertainty pushes some businesses to double-check their inventory numbers using periodic inventory counts. The advantages of a periodic system are that it's relatively simple and setup costs tend to be lower. However, since you're only checking your inventory levels periodically, this can lead to delayed results. I'll explain how that works later in this video. Another problem with this system is that you have less control over your inventory. It can be hard to know what happened between each inventory count. Now I'm going to show you how perpetual and periodic inventory systems work. And to help me explain, we'll use an example. Imagine that you own a bookshop. It's the end of September and you're holding 300 books that cost you $8 per unit to buy. In October, you buy another 500 books at the same price, $8 per unit, and you sell 450 books for $15 a unit. Notice that we're keeping the cost price exactly the same in this example. In the real world, it changes, and we need to make assumptions to help us value our inventory. There are 3 ways to do that: FIFO, LIFO, and average cost. I'm going to cover all of these in future videos in this playlist, so remember to hit subscribe if you'd like to see those.
Fuck,
My question
I
is,
remember now. I remember studying
inventory systems.
actuarial accounting.
What's your cost of goods sold in October? Let's find out. We'll begin with a calculation. At the top, you have your opening inventory plus your additions for October. When you add these together, you work out your cost of goods available for sale. And below that, if you subtract your cost of goods sold, then you come to your closing inventory, your inventory on hand at the end of the period. This calculation is going to be our foundation for the rest of the example. We'll use it to work out your closing inventory and your cost of goods sold for October using both the perpetual and periodic methods. Now, I want you to pay close attention to timing. When is it that you first find out your cost of goods sold under each method? This is key to understanding the difference between the 2 systems. Right, I put together some steps to help us work this out. We'll run through them now, but you can also find them on my inventory systems cheat sheet, where I summarize all of the key points I make in this video on one page. You can help support this channel by buying it on my website. There should be a link to it up here, and I'll drop one in the description as well. Step 1. Last period's closing inventory becomes this period's opening inventory. If we refer back to our calculation, we're thinking about this top line, opening inventory.
Opening.
Beginning inventory, the inventory that you have on hand.
Opening inventory, so this is like yang kemarin lah. Addition berarti yang baru. Cost of good available for sales. I'm guessing itu dijumlahkan. Terus dikurang kayak berapa yang dijual di periode. So kita punya berapa terakhir closing inventory. And closing inventory is going to be the opening inventory for the next period. Okay.
Start of October. How do we know that? Well, we said you closed out September with 300 books costing $8 per unit.
So apa namanya? Because we have 300, that means it's gonna be the opening inventory. So that's 300 books. Yeah.
300 multiplied by $8 gives you 2,400.
So this
That's
is
your closing
the opening
you
inventory.
need to bring forward into October.
Yeah.
Step 1 is exactly the same, whether you're using the perpetual or periodic system.
Opening
Since
inventory.
is a normal debit account,
Yeah.
we can show this opening inventory as a debit of $2,400 on the left-hand side.
Debit masuk.
To
Okay.
your inventory T account. Remember, debits always go on the left and credits always go on the right. Always, always, always. Time for step 2, and here's where we start seeing some differences between the two systems. Under the perpetual system, this is where you record additions in your inventory account. But under the periodic system, this is where you record additions in your purchases account. In October, you bought 500 books costing you $8 per unit. 500 multiplied by $8 is $4,000. That's your additions for October. Under the perpetual system, you record dollars per unit. 500 multiplied by $8 is $4,000.
Yeah, $4,000.
Additions for October. Under the perpetual
That's on October.
system, you record these additions as a debit to inventory of $4,000.
Okay.
And depending on how you settle the transaction, a credit to cash or accounts payable of $4,000.
Yeah.
But
Addition.
what about the periodic system? Here, the journal entry is very similar. However, there's one
Periodic
difference.
system.
You don't debit your inventory account. You debit your purchases account instead. You debit purchases by $4,000 and credit cash or accounts payable by $4,000. The purchases account only exists under the periodic inventory system. It holds all of the inventory that you purchased during the period. At the end of the period, this will get cleared out to zero. I'll show you how that works towards the end of this video.
Okay.
Going on to step 3, how to recognize inventory sales. Under the perpetual system, this is where you recognize revenue and record cost of goods sold as sales take place. But in the periodic system, you only recognize your revenue as sales take place. You might remember from my last video that setting inventory triggers 2 places. But in the periodic system,
Recognize revenue and cost of goods sold (COGS) as sales take place.
you only recognize your revenue as sales take place.
Recognize revenue as sales takes place. So revenue aja and cost of goods.
You might remember from my last video that setting inventory triggers 2 journal entries. You recognize revenue in your income statement and you release cost of goods sold from your balance sheet to your income statement. Under the perpetual system, you'd record this by crediting your revenue account and debiting your cash account or accounts from your balance sheet as receivable. But how much revenue should you recognize? Well, you sold 450 books at $15 per unit. 450 multiplied by $15 gives you $6,750. So you credit revenue by $6,750 to increase your earnings in the income statement, and you debit cash or accounts receivable by $6,750 to increase your assets in the balance sheet. In the second journal entry, you release the cost of goods sold from your balance sheet to your income statement. You sold 450 books which you bought for $8 per unit. 450 multiplied by $8 is $3,600, and you need to release this from your balance sheet because you're no longer holding this inventory. So you credit inventory by $3,600 to release it from your balance sheet, and you debit cost of goods sold by $3,600 to record the expense in your income statement. Okay, but what about the periodic system? In the periodic system, you only recognize your revenue as
Revenue aja kan?
so
Yeah.
setting inventory only triggers one journal entry to recognize your revenue. You have no idea what your cost of goods sold are at this point because you haven't counted your inventory yet. So you credit revenue by $6,750
Yeah.
cash or accounts receivable by $6,750, and that's it.
150.
Step 4. With the perpetual method, inventory
Sales.
is updated in real time. At any given point, you know all of the variables in this calculation, so your closing inventory balance is continuously updated. In this example, your cost of goods available for sale was $6,400, and you sold 450 books costing you $3,600. That's your cost of goods sold. And when we take the difference, you're left with your closing inventory balance of $2,800 in October. To find your closing inventory and your cost of goods sold under the periodic system, we need to fast forward to the end of October. You still have 2 more steps to get through. In step 4, you need to clear total purchases to your inventory account. What does that mean? It means that you need to post a journal to clean all of your October inventory additions out of your purchases account and transfer them to your inventory account. So you credit purchases by $4,000 and you debit inventory by $4,000. This might seem a bit silly with only one addition in this example, but if you buy inventory in multiple batches throughout a period, then this way of doing things is a lot cleaner. Right, it's time for your inventory count. You head to your storage room where you keep
Yeah, my brain
all of your
totally
in step 4, you
munch
need to clear
out,
total
bro.
purchases to your inventory account. What does that mean? It means that you need to post a journal to clean all of your October inventory additions out of your purchases account and transfer them to your inventory account. So you credit purchases by $4,000 and you debit inventory by $4,000. This might seem a bit silly with only one addition in this example, but if you buy inventory in multiple batches throughout a period, then this way of doing things is a lot cleaner. Right, it's time for your inventory count. You head to your storage room where you keep all of your books and you physically count all of your inventory on hand. 350 books in total. That's your closing inventory. In step 5, you update your closing inventory and calculate your cost of goods sold. These books cost you $8 each to buy. 350 multiplied by $8 is $2,800. That's your closing inventory balance, which we can pop into the calculation here. But there's one final piece to this puzzle. You still need to find out your cost of goods sold, and you can do that by rearranging this calculation. Your cost of goods available for sale less your closing inventory gives you your cost of goods sold. $6,400 less $2,800 is $3,600. So to recognize this in your income statement, you debit cost of goods sold by $3,600 and you credit inventory by $3,600. You can see that your cost of goods sold under the periodic method is exactly the same as the cost of goods sold you calculated under the perpetual method. The difference is in the timing. In the perpetual system, you were able to see your results in real time because both your revenue and your cost of goods sold were continuously updated as you sold your inventory. However, in the periodic system, you needed to wait for the inventory count at the end of the month to find out your cost of goods sold. It took longer to find out your results. There you go. You can find my cheat sheet covering periodic and perpetual inventory systems up here. In this next bit, we'll cover 3 inventory cost flow assumptions: FIFO, LIFO, and AVCO. We'll start with FIFO, which
Bentar.
stands for first in, first out. I'll show you a four-step process to calculate cost of goods sold and closing inventory. When do we need inventory cost flow assumptions? Let's think back to our inventory calculation from the previous video. Opening inventory plus additions gives us cost of goods available for sale. And when we subtract our cost of goods sold from this, we get our closing inventory. Now here's the thing, up until now we've assumed one constant cost price across all of your inventory, but in reality this isn't always the case. Your opening inventory might cost you $2 per unit, but your additions might cost you $3 per unit. So your inventory on hand or your cost of goods available for sale could be made up of a whole mix of $2 and $3 units. And when you get around to making a sale, you need to work out how much of this cost needs to flow out of the inventory account in your balance sheet into your
What
cost
the
of goods
fuck?
sold account, an expense account kept in your income statement, and also how much of this cost should remain where it is in your closing inventory.
Hello.
To work this out, goods
I bet it's fucked.
for your addition available for sale, and back to our inventory calculation from the previous video. Opening inventory plus additions gives us cost of goods available for sale.
Set.
Subtract our cost of goods
Terus
sold from this,
cost of
we
goods
get our
sold.
closing inventory.
Positive
Now
inventory.
here's the thing, up until now we've assumed one constant cost price across all of your inventory, but in
Yeah.
reality this isn't always the case. Your opening inventory might cost you $2 per unit, but your additions might cost you $3 per unit. So your inventory on hand or your cost of goods available for sale could be made up of a whole mix of $2 and $3 units. And when you get around to making a sale, you need to work out how much of this cost needs to flow out of the inventory account in your balance sheet into your cost of goods sold account, an expense account kept in your income statement, and also how much of this cost should remain where it is in your closing inventory. To work this out, you can use cost flow assumptions. Cost flow assumptions are rules that help us estimate what these cost flows are. These are assumptions, so they don't necessarily reflect the reality of underlying transactions. There are three main types of cost flow assumption: FIFO, LIFO, and AVCO. First in, first out, last in, first out, and the average cost method. Okay,
First in, first out, last in, first out, average cost.
so FIFO, first in, first out. What's this all about? When you make a sale using the FIFO method, you make the assumption that your oldest inventory is going to be sold first. Your oldest inventory is what you bought first, so you're going to imagine that you sell it first every time. First in, first out. But how do you account for this? I think it's time for an example. Business is booming in the window cleaning industry. Word of this catches your ears and you decide to get into wholesale, buying and selling squidgies in bulk. Yep, that's what these are called. Squidgies. It's the beginning of November and you have 220 squidgies in your inventory. You bought these for $2 each. On November 5th, you buy another 400 squidgies for $1,200. And on November 12th, you sell 500 squidgies for $2,750. Question: what's your cost of goods sold and closing inventory for November, assuming that no other transactions have taken place? And
Wait, okay. So we sell 500. So I'm gonna calculate myself. So open squeeze. So the opening inventory. This is what I like. So inventory is 200 squeezes times $2. So $140. Right? Or I guess you can. There's 220. Okay, there's 220. But on November 5th. Okay, I get it. So and November 5th, if you buy 400 for total of, so each squeeze costs $3. So $3 equals 1,000. There is there's 400 actually. Sorry, there's 400, not 300. And then we sell at November 12th. That means and we sell for 500 and 275. 275 divided by 500. So there is $5.5. $5.5. 275. 2750. 250. There is 500 sold. Because there is 500 sold, we need to sell. We like the first one is the one that we sell. This is assumption, and that means the amount of revenue, I guess you can call it, it's okay, yeah, the cost of goods sold is gonna be the $440, yes, plus 280. So that's the amount. That's 500 times $3. So if we, yeah, I have this 280 times 3 is $840. So that is, and then we just this with 450. So I'm guessing COGS-nya $1.280, but as we sell in November, okay, yeah. First in, first out, yeah.
$2,750.
Last year.
What's your cost of goods sold and closing inventory for November, assuming that no other transactions have taken place and that you're using the FIFO cost flow assumption? First in, first out. To help you get to the bottom of this, I put together 4 steps, which we're going to run through now, but you can also find
And closing inventory.
them on my cheat sheet. You can help support this channel by buying it on my website. I'll link to it down below. Step 1. Draw an inventory cost flow table. What on earth is that? It's a table made up of 5 columns. Date, description, quantity, cost per unit, and total cost. Okay, step 2. Enter what you know. Here's where we use the information given to us to fill out as much of this table as possible. So let's do that. You began November with
the
220
verse.
squeegees, which cost you $2 per unit. So on November 1st, you had an opening inventory made up of 220 units, which cost you $2 per unit.
Cost
2 days later, you bought another 400 squeegees, which cost you $1,200 in total. We'll add that to the table as well. On November 5th, you made additions of 400 units, which cost you $1,200 in total. In an inventory cost flow table, you want to leave an empty row beneath addition or sale. This is where your subtotals are going to go. Your goods available for sale or your closing inventory after the final transaction. It will become clear why in a moment. Okay, finally, on November 12th, you sold 500
So,
units for $2,750. So on
yeah.
November 12th, you sold 500 units.
Goods sold 500, yeah.
These squeegees. The sale reduced your inventory on hand, and you sold these for $2,750.
So add,
deduct that here. Hold up, wait.
yeah.
That you sold 500 squeegees for $2,750. This is the revenue that you made, not what these squeegees actually cost you.
What?
So we can't enter the $2,750 into your total cost of goods sold. We'll have to work this one out. We're also going to need to work out your closing inventory at the end of the month on November 30th, which brings us on to step 3. It's time to fill in the blanks. There are a couple of things to be aware of when filling out a cost flow table under FIFO. We'll need to calculate the cost per unit of your opening inventory and additions, but you can ignore the cost per unit of your goods available for sale, goods sold, and closing inventory. We'll start off by calculating the total cost of your opening inventory. You began the month holding 200.
Yeah, this is easy.
220 multiplied by $2
berapa ya?
$440. Next up, we have to work out the cost per unit of your additions. You bought 400. That's it. Now, we'll take. That's quite an increase from the cost per unit of your opening inventory. Something to bear in mind when picking inventory cost flow assumptions, but more on that soon. Now, we'll take some subtotals to work out your goods available for sale. 220 units plus 400 units is 620 units available for sale, and $440 plus $1,200 is $1,640. Your total cost of goods.
Yeah, cost per unit doesn't matter.
Remember, I said under FIFO we can keep the cost per unit of your goods available for sale and goods sold blank. That means we can move on to working out your total cost of goods sold.
It doesn't make any sense
First in,
mathematically as well.
You sold 500 units, but what did it cost you? Well,
Yeah.
under FIFO, the first units you bought in are the first to be sold. You
Yeah.
have an opening inventory of 220 units, which cost you $2 per unit, but you still need to sell another 280 units to reach 500.
Yeah.
The next 280
Makanya
units come from
280.
cost you $3 per unit. So here's our workings. 220 units multiplied by $2 is $440.
Yeah.
280 units multiplied by $3
3?
is $840.
So 1000 sama benar.
This is your total cost of
Same
goods
ya.
sold. Nice work. That was the hard part. Now let's take some totals to find out. your
So
closing
good
inventory.
sold. Nah, this is the
620 minus 500 gives you 120 units, and 1,640 minus 1,280 gives you $360. Your total cost of closing inventory. Step 4. Calculate your total cost of goods sold and your closing
Fuck.
inventory. Well, like
Time is already up. Okay, break.
Sunlight streaming into the newly opened gap 差し込む光が誇りの粒を踊らせ
Is there a future in the simple hope ただ待っているという数秒の感動さが自分というエゴを静かに溶かしていく月の持ち手とリレーをつなぎ穏やかな午後の白道 刻む
Yeah.
Step into the rhythm of the open door 開けられた扉の流れに乗って The rhythm is smooth, the gap is wide 不器用な親切をグルーヴに変え Floating in the grace of the shared space
Ut.
The hinge is quiet but the impact is loud 明日優勝 careful 一度だけ買い離して Deep in the flow of the gentle transition 扉がゆっくりと閉まる風のささやきハイドに残った温かな気配が闇を払朝のまれたクロスウォーク朝のうどんほど譲り合った車列 A ripple of peace and the morning rush 意尺の角度が生んだかすかな余裕ブレーキを緩める指先の優しさ Invisible threads connecting the strangers いつもより少しだけ軽やかなアクセル誰かの一日を肯定するサイン情報の濁流を一瞬だけ止めて再生がし空気が車内を満たしていく Dust the review mirror reflecting a smile バック未来に映る名もなき感謝 It's not a duty, it's a natural flow フロントガラスを滑る光の流地不要な苛立ちを裏方に捨て去り淡い標高の中を滑り出す世界はまだ善意の連鎖を信じている Riding the wave of a silent thank you 不思議の余韻をビートに乗せて The rhythm is one, the signal is clear 不器用な解釈をメロディーに変え Cruising through the grace of the city morning Shadows of trees waving to the commuter sky 路上が揺れて尺を返す
Did it fucking pause? Oh. Fuck? I get it.
Well, like I said, the hard part is over. Your total cost of goods sold for the month can be
Yeah,
calculated.
but the revenue, how do you...
Goods sold for each sale. Here, you've only made one
Okay.
sale, so your total cost of goods sold for November is $1,280, and the total cost of your closing inventory is $360. The inventory cost flow table makes it easy for us to work these out, and if any of this looks familiar to you, it's because it mirrors the inventory calculation that we had up earlier. So why would you choose the FIFO method? Well, it's one of the easiest cost flow assumptions to use in practice, and in an inflationary economy where prices are rising, the cost of your inventory might be going up, like it did in this example. So choosing FIFO can make your profits look bigger because you're matching your current revenues against your older, cheaper cost of goods. Revenue less cost of goods sold is gross profit. Can make your profits look bigger because you're matching your current revenues against your older, cheaper cost of goods. Revenue less cost of goods sold is gross profit. And as you can see in this example, your gross profit calculated under FIFO is larger than your gross profit calculated using the LIFO or AVCO methods. But as a business owner, this isn't necessarily a good thing. High profits can mean high taxes, which can negatively impact your cash flow. So if possible, it's worth considering the last in, first out, or average cost methods. In my next two videos, we'll explore these. So let's see how they work. We'll begin with LIFO, which means last
Okay,
in,
next
first
is
out.
last
When you
in,
sell using the LIFO method,
first
you
out.
make the assumption that your newest inventory will be sold first. Last to come in, first to go out. Time for an example. We're going to use the same one that we did in the FIFO video, which means Swidgies. It's the start of November, and you have 220 Swidgies in your inventory. These cost you $2 each. On November 5th, you buy another.
Isn't the better one the average
2
cost?
days later, on November 12th, you sell 500 Swidgies.
That's what I think.
What's your cost of goods sold and closing inventory for November, assuming that you're using the LIFO 500 Swidgies?
So we have opening with 220 and buy 400 plus squeeze and sell 500. So yeah, that average is really good, by the way. So opening, there's 220. This is $2 per unit, and it's gonna be $440 total unit. And this is Is it November 1st? That's what I think. I don't know. No, November 5th. It's gonna be we addition that addition. There is 400 squeezes. It's a 400 unit with what 1 point $1.2, and that means there is $3 per unit, right? And November this is the same. So November 12th, I think cost of goods sold no, goods sold. So there is 500 squeeze. No, it doesn't make any sense. No, it does make sense. November 12th, goods sold. I think the goods sold. There is 500 unit. This one doesn't matter much, and sells squeezes for 275. I don't think it. Wait, there's a better name for it, but definitely not cost of goods sold. So blah blah blah. There is 660 unit, and it's $164. And there's another thing again. I think this one is cost of goods. Goods sold. I'm pretty sure we sold 500. So 500, right? Because we use LIFO, that means it's gonna be 400 times $3 plus 100 times $2. So this is okay. So 440 and yeah.
For $2,750. What's your cost of goods sold and closing inventory for November, assuming that you're using the LIFO cost flow assumption? Last in, first out. It's time for some steps. We'll go through them now, but you can also get them on my inventory cost flow assumptions cheat sheet. If you're finding these accounting tutorials at all helpful and you'd like to help support the channel, then the best way you can do that is by buying one of my cheat sheets. You can find the link up here and down below as usual. Step 1. Draw an inventory cost flow table. This is a table made up of 5 columns, all to 1,200 inventory cost flow. Now be careful here. Total of the rows.
Goods available for sales.
On
Okay.
12th, you sold 500 squidgets for $2,750. Now be careful here. This $2,750 is the revenue that you've earned, not the cost of goods sold that you've incurred. So it doesn't belong in the inventory cost flow table. So on November 12th, you sold 500 units, and that's all we need for this transaction. We'll need to work out your total cost of goods sold later. We're also going to calculate your closing inventory on November.
Closing. Fuck yeah. That's what is closing inventory.
We'll begin by calculating the total cost of your opening inventory. You kicked off the month with 220 units, which cost you.
This is November
220 multiplied by $2 is $440. Next, we'll work out.
So there is 160 units.
$1,200 in total. $1,200 400 units.
With the value of
now we can take some subtotals to work out your goods available for sale.
$240.
620 units available for sale. And 440 plus 1,200 is $1,640. Your total cost of goods available for sale. And using the LIFO or FIFO methods, you can ignore the cost per unit of your goods available for sale, goods sold, and closing inventory. So we can move on and calculate your total cost of goods sold. You sold 500 units, but what was the cost of goods sold that you incurred in this transaction? Remember, LIFO means last in, first out. The last switches you bought were your additions of 400 units, which cost you $3 per unit, but you still need to sell another 100 units to reach 500. The next 100 units come from your opening inventory, which cost you $2 per unit. So let's work this out. 400 units multiplied by $3 is 1,200 on the 30th. To do that, we need to take some totals. 620 minus 500 gives you 120 units, and 1,640 minus 1,400 gives you $240. All right, step 4. Calculate your total cost of goods sold and your closing inventory. Your total cost of goods sold for the month can be calculated by adding up your cost of goods sold for every sale that you've made. In this example, you only made one sale, so your total cost of goods sold for November is $1,400, and the total cost of your closing inventory is $240. But you can use these same 4 steps to solve any $400 cost flow problem. Now let's have another look at the inventory calculation. Why would you choose LIFO over the other inventory cost flow assumptions? This method allows you to match your current revenues against your most recent cost of goods, so your gross profit reflects your business's current performance. However, when prices are rising during times of inflation, your most recent cost of goods, so your gross profit reflects your business's current performance. However, when prices are rising during times of inflation, your most recent cost of goods are also your highest, which gives you a higher cost of goods sold. Remember, those squidgies in the example went from costing $2 per unit to $3 per unit. This gives you a lower gross profit. So when we compare your results using LIFO against the FIFO and ACCO methods, your gross profit under LIFO comes in the lowest. But as a business owner, this can be a good thing. Businesses are charged tax on their profits, so lower profits means lower instead. IFRS. So if you follow international financial reporting standards, then you'll need to use first in, first out. Last in, first out is not allowed under IFRS. So if you follow international use owner, this can be a good thing. Businesses are charged tax on their profits, so lower profits means lower taxes, which can free up more cash for you to use in other areas of your business, at least in the short term. But be careful, last in, first out is not allowed under IFRS. So if you follow international financial reporting standards, then you'll need to use first in, first out, or the average cost method instead.
Well, there's only one cost flow assumption left, and that's AVCO, the average cost method.
Inventory calculation. There are three inventory. Remember, when I say inventory, I mean the goods held by your business that you intend to sell to earn revenue. The thing is, when you make a sale, you don't only earn revenue, you also incur a cost, and inventory cost flow assumptions help you estimate what that cost should be. There are three inventory cost flow assumptions: FIFO, LIFO, and AV. Using average cost per unit by taking your total cost of goods available for sale and dividing it by your quantity of goods available for sale. Don't worry, we'll come back to this equation soon, but first, I'd like to give it some context. Let's imagine that you work in wholesale in the window cleaning industry, buying and selling squidgies. It's the beginning of November, and you have an opening inventory of 220 squidgies, which each cost you $2 per unit. On November 5th, you go and buy another 400 more squidgies for $1,200 in total. And on November 12th, you manage to sell 500 squidgies for $2,750. The question is, what's your cost of goods sold and closing inventory for November, assuming that you're using the weighted average cost method to value your inventory? It's time for that 4-step process. Step 1, draw an inventory cost flow table. What's that? It's a table with 5 columns: date, description, quantity, cost per unit, and total cost. Step 2, enter what you know. Okay, well, we know that you started November with 220 squidgies, which cost you $2 each. So at the start of November, you had an opening inventory of 220 units, which cost you $2 per unit. A few days later, on November 5th, you purchased another 400 squidgies for a total cost of $1,200. We'll need to pop this in the table too. On November 5th, you made additions of 400 units, which cost you a total of $1,200. In inventory cost flow tables, it's important to leave a blank row under each addition or sale. This gives you some space to calculate your goods available for sale. Finally, on November 12th, you sold 500 squidgies and earned $2,750 in revenue. Now be careful here. This is the revenue that you've earned, not cost of goods sold that you incurred. So this doesn't have a place in the inventory cost flow table. That means on November 12th, you sold 500. Next, we need to do 1,000 for sale. Right, so you're $22 in mind for the next bit. The weighted average cost per unit of goods sold. We already
2.65?
So what's your weighted average cost per unit?
2.58. 2.48. What the fuck?
Of your goods available for sale. $2.65 per unit. It's your weighted your sale. All right, keep this number in mind for the next bit.
Oh, 620. Fuck. What? Oh, shit. I miss. Can I change this? Okay. So 2.65. Okay.
Total cost of goods sold. Your total cost of goods sold is your quantity of goods sold multiplied by the weighted average cost per unit of goods sold. We already know that you sold 500 units, but what's your weighted average cost per unit of goods sold? It's exactly the same as the weighted average cost per unit of your goods available. And how many units of inventory do you have left over? Well, 620 minus your cost per unit earlier on, so this is an estimate. Step 4, calculate your total cost of goods sold sales, and you can find
Purchase biasa
so your total cost
1.335 and we closing inventory.
matches your current it's like the middle ground between first in, first out,
Yeah.
first in, first out methods. What do I mean by that? Well, FIFO matches your current revenues against your older cost of goods, whereas LIFO matches your current revenues against your most recent cost of goods. AVCO falls somewhere in the middle. It uses a weighted average. So, for example, during times of inflation,
Yeah, this is the weighted average.
cost of goods sold under LIFO tend to come out the highest because it reflects your most recent purchases, and your cost of goods sold under FIFO would come out the lowest because this assumes that you're selling off your older, cheaper inventory first. With the average cost method, your results come out somewhere in the middle.
There you go. That's merchandising inventory in a nutshell. We didn't really get on to manufacturing.
Okay. Very interesting. It took a while. Okay. Now, let's read the actual fucking PowerPoint. Hey, someone's watching. Hello. Okay. Analysis of inventories. Okay.
Floating in the echo of a small kindness 無垢なつながりに背中を預ける目的地へ続く道が輝きを増し最後の手振りが視界の端で温かく残る
Okay, let's read it. Lower cost and net realized value. All costs of bringing the inventory to its current location and condition. Portion cost as close as inventory, purchase costs, less discount, and rebates. Conversion costs, including labor and overhead. Other costs necessary to bring the inventory so it's present in the shop. And at end.
Of the fabric 畳んだ後に滴る誰かの時間の後 Is there a soul in the rusty spring ただそこにあったという救済の形が冷え切った指先を静かに頭に
Okay. Based on the provided slides, here are some inventory valuation rules under IFRS and US GAAP highlight their key differences. Lower costs and net realizable, lower costs and market value, defined as NRV, divine market definition, defined as current replacement cost subject to ceiling and floor. Reversal of write-down allowed if the value recover but only up to original cost. Once written down, it stays down until sold. Under IFRS, inventory must be reported on the balance sheet and at whichever is lower. The lower the original cost and or the net realized value. So I'm guessing IFRS is much more conservative, but okay, so what is NFR? NRF then? So, under IFRS, inventory must be reported on the balance sheet, at which is lower, the original cost or the net realized value. What's this happen?
of the old guardians 動かないままで享受する放題な余白意味を持たない緑のさざめきに同調する Yeah empty bench waiting for the next one だらペン昨日ハゲた国際の素朴な手触り It's not a gift it's a fundamental grace 不評な理屈を土の中へ返しただそこに座れる行く事実を噛みしめる Resting in the shade of the park canopy 公園の木陰で意識を緩め The light is filtered, the air is cool 不器用な直射をメロディに変え Drifting in the green sea of the urban oasis Distant sound of children playing in the sand 砂場で響く無邪気な笑い声の破片 Is there a peace in the midday sun ただ健やかに過ぎるという結 一部が自分という歪みを平坦に整えていく The wind is soft, the thoughts are aloft 明日という距離を一度だけ調整して Deep in the rustle of the living branch Yeah 音が一夜ハートを立てて低い空へ飛び立つ木漏れ日がトンバンをゆっくりと西へスライドしていく
What the fuck? NRV is 203. Selling, estimate selling price. Uh,
Soft hum of the neighbors heater through the wall 隣室から漏れるかすかなけど Hope a silent proof of life in the concrete Sinking with the breath of the midnight city 深夜の金管を深く吸い込み The pulse is slow, the connection is real 不透明な孤独を安らぎに変えて Floating in the grid of a sleeping world
誰もいない通りで等間経験にまたがく前ちょっと遠いビルの浴場でまたが赤い灯火ビルのシグナル
High-end card GPU manufacturer. This is a classic CFS style problem that tests the difference between mathematical thresholds for variation. So we have the scenario: a high-end GPU inventory. The original cost is $1,000. The current replacement cost (CRC) is $850. The estimate selling price is 950. Estimate selling cost is 50, and normal profit margin is 100. IFRS use the net realized value as a benchmark. Step A, calculate the NRV. The estimate selling price is 950. The selling cost is $50. There's another metric, estimate cost of completion. I'm guessing you are manufacturing stuff when that happened, right? Oh, sorry, it is like a manufacturing company where you turn raw material into something, right? But I'm gonna use an error, but okay. So NRV is $900. Determine the carrying value. The value is lower. The original cost is 1,000 and NRV. So we use NRV because it's lower. Because IFRS used to lower between the original cost and the net realizable value. And okay, impact is 100 loss is recognized in the income statement. US GAAP, so NRV is 900. The floor is NRV divided by profit margin, so 800, and the limit is the fucking NRV, so between 800 and 900. So, and the replacement cost is 850. Step 5, identify a market. Market is the middle value of these three values, 900, 800, and 850, which is 850 now. Determine the carrying value. The value is the lower cost, and the market is 850. Carrying value. Final USGAAP. Alright. I have estimate the firm can reverse the previous write-down. They write the inventory back to its original cost, 1,000, and recognize a hard gain from the income statement. Are prohibited. Fuck. Why the fuck is it on the balance sheet? It is an income statement. Why is... I'm so dumb. Okay. The balance sheet is not... I don't care about that. There's one time when inventory moves to the income statement without sales happening. If your inventory loses value, it gets altered, damaged, or the market price drop, you must perform a write-down. What happened? You decrease the inventory value of the balance sheet. Where it goes is recognized as loss or increase in cost of goods sold on the income statement. Lu nge-credit inventory nggak sih? Probably sama other some kind of kalau it's already over. Come on, I'm still 25 menit detik lagi. Double entry accounting. Okay. JOGS, cost of goods sold. You're recording the cost of operating that revenue, and the asset is devaluating because asset depreciate usually. Okay. Break time. I wanna hear the final song. Sweet love. Sweet element. What the fuck? Did Discord introduce fucking ads? No, I want to learn SQL someday. Sounds like not a fun language too. Just want Is the time? How long is it? Oh, still 1 more minute. Oh my internet is starting to get ass. Just want you with you. But this is a good midnight song. When you're driving, this is a badass song, bro. Oh fuck, my bad. Why the f- Give me a second. Urung kan? Sorry. Man, Indonesian word in English is so urung kan backwards. No, I always backwards. Undo. Urung kan.
Manufacturing inventory. If you like these
A warm resonance in the convenience store.
Okay, I need to go to the toilet. While timer run outs, should be soon. There you go. It's already run out. Okay, back to studying.
Binary signals blinking in the twilight. Shadanki no mae deka was flashing no eyes. A silent permission at the edge of the rail. Taikonsha senkara totoki yuzuri ai
Okay. Let's kinda products cost.
Mutual respect in a metallic stream. Handle wo nigiru te no hira ni tsudawaru shindai. Mishiranu dareka no jikan wo skoshi dake hirogeru.
Separate line item or by increasing cost of goods sold. Increasing cost of goods sold. Yeah, makes sense ya kayaknya. Karena tapi inventory-nya bakal kurang. Yeah, because if the value of the inventory recovers later, the inventory can be weighted up and again recognized in the income statement as a separate item for option. The inventory is valued at the lower cost or NRV. Inventory cannot be written up by more than it was previously written down. Inventory valuation USGAP, lower cost market and market allow cost, bringing inventory as current location and condition the same as at. Current replacement, current CCR subject to same. Replacement costs. Okay. Example: Zoom Inc. sells digital camera. Per unit cost information pertaining to Zoom inventory is, so original cost is $210. Estimate selling price is $225. Estimate selling cost is $22. Net realizable value 203. Replacement cost and normal profit margin. What are per unit carrying value of Zoom inventory using lower cost or NRV and lower cost or market? Lower of cost or market. Lower of cost or NRV because they the first one is using IFRS, the second one using USGAP. Using the lower cost or NRV because the original cost is $210, exceed the net realizable value. This is the original cost, and the net realizable is $235. Selling price divided by the cost, is 203, which is the net NRV. So we pick the 203 as the reported in the income statement, right? Which we put in a separate line, or we increase cost of goods sold, and that means because we increase cost of goods sold, we lower inventory. We credit that and we debit. We debit cost of goods sold and we credit inventory. I think using the lower of cost or market is equal to the replacement cost. Replacement costs are 97 because NRV is 203 and replacement cost CRC, right? Current replacement cost. Okay, so current replacement cost. Okay, so 197 NRV, which is net realized value, is bigger than current replacement cost or CRC, is lower than NRV minus profit margin, and I think I will scale 203 minus 12. It's not even make sense. The inventory is written down 2907 and a loss of 13%. Where's the 13% come from? Because the original cost. 170% cost minus is reported now. Replacement cost. Oh, this value down. I feel like B is a better option, but for investor B is a better option because we can put it on the cost of goods sold. So the income statement, yes, GAAP is a bit more aggressive in this example because the market value, IFRS per unit. Okay. Similar to IFRS, is typically recognized in the income statement for the period the value declined. It most commonly increase in cost of goods sold. This is not in a larger hit in the periodic margin compared to IFRS. Cost. Okay. Comparison of the stories on the income statement. Revenue. Blah blah blah. And the QGS includes the 7% write down, includes the 30% write down. Lower, basically much lower, 50% decrease significantly. Fuck. Okay. Assume that then in the year after the write down in the previous example, NRV and replacement costs both increased to $10. What is the impact of recovery under IFRS and under GAAP? GAAP doesn't matter; it's still the same, pretty sure, right? Under IFRS, Zoom will write up inventory to 210 per unit. To recognize a 7% gain in its income statement, the write-up gain is limited to the original write-down. Carrying value cannot exceed in original costs. Under the USGAP, no write-up is allowed. The per unit carrying will remain the same and production of games, related item, gain on inventory, recovery. There's a strict mathematical limit on how much a gain you can report.
pencil on a thick pad 黒い閲覧室に漂う紙のビリウス A concentrated silence and the wooden hole Reading this score I feel like very silence 多少指数の譜面を静かに読み The rows are endless time is slow
Inventory asset after write down. Total current asset, decreased current ratio, current asset, and current. What is chat again? What is this? Current asset divided by current ratio. Current asset per liabilities again. Oh yeah, sure. We discussed it. Right. That's shit. Quick ratio, no change. Account receivable. Picture in the privilege. Oh no, it's current asset, right? The fuck? What is the quick ratio? Somewhere here. Wait, is it on? Is it on 1B? Just such a quick ratio. Ratio.
Faint smell of ink in old letter bindings 各表紙が放つ数十年という takes like Is there a bridge in the printed word ただ誰かが残したという思考の跡が自分という孤独を静かに救済する The book is closed, the truth is exposed 明日という見どこを一度だけ保留して Deep in the ink of my shared past Hey fake
What did you? Oh yeah, it is cash. Cash, market securities, account receivable, liability. Yeah, there's nothing in it. That makes sense.
Blue illumination of the stainless panel フリル階のボタンを代わりに押す指
Debt to asset. What is equity decrease? Oh, okay. That makes sense. Liabilities stay the same, but the asset like decrease, right? So because that equity to debt get lower, so debt to equity get higher. Decrease in cost of goods sold, decrease gross margin. Yeah, sense. Operating margin and net margin. Operating income, right? And I've this. Somewhere. I want to look at one. There has to be the stable here, right? Yeah. Is this? Yeah. No. Analyzing financial statement. Where the fuck is it? Oh yeah, this is gross profit, operating income because we operating expenses. And then what is it? Gross operating and net margin. What is net margin? I don't know. What is net margin? What is net margin? And in the income statement, it's definitely below. It's below operating margin, pretty sure. Operating margin, right? But higher than earning slash net income. Right. Can type. Okay. Increase in cost of goods sold, decrease gross margin. Okay. The percentage decrease in net income. The percentage increase. The percentage decrease in net income. Net. Earnings can be expected to be greater than the percentage decrease. As a result, both return on asset and return on equity decrease. Equity I know is how do you call it? ROI again? Just a minute. Return on equity is net income divided by shareholder equity, or the average shareholder equity. That's a cool formula. Net profit sales divided by asset by equity. That's a cool DuPont formula. Yeah. Okay, now 5 more minutes. LIFO versus FIFO. Bro, ini masih setengah halaman lagi anjing. I was locking in the fucking video. Okay. LIFO versus FIFO in inflationary environment. Income statement, CAGS, EBT, earning before interest and tax. So this is earning before tax, taxes, profit margin. Oh iya, definitely kayak kalau di Vivo COGS is huh? Oh yeah. For inflationary period, that means the older stuff is cheaper than the newer stuff. For example, in Oktober itu $2 per unit, tapi bisa di November $3 per unit, naik kan dari 2 ke 3. Because FIFO is first in first out, yang $2 yang bakal dijual dulu, baru yang $3. Kalau last in COGS bakal naik. But kalau di inflationary period, inflationary environment, I'm guessing it's like almost everyone. Kenapa earning before taxes-nya tinggi? Inventory ending makes sense karena COGS-nya lebih rendah, makanya inventory bakal lebih besar. In general, but operating cash flow, but ama EBIT dah, dulu dah, EBT, bukan earning before taxes. Here lah paling. Earning before taxes kan revenue, COGS, operating income, blah blah. Wait, I need what is operating income, terus palingan EBIT somewhere in the middle, right? Kita belum taruh tax and stuff. It should be here. Earning before tax, income before tax, sama aja. Unusual and frequent item, interest expenses, again, so pre-tax income. Okay. I'm guessing karena Ciagesnya turun, makanya EBITDA naik. That's why. What is taxes? Isn't taxes stay the same? Profit margin makes sense. Profit margin kan dikurangin cost of goods sold ratio. No, I'm wrong. Fuck. Okay. Okay, I wanna know why the fuck is operating cash flow goes down. Why does operating cash flow goes down in an inflationary environment using FIFO? Environment. Environment. In an inflationary environment, prices are rising. Under FIFO, you assume that the oldest and therefore the cheapest items are the ones that you sold first. While this makes your company look very successful on the income statement, it creates tax penalty on the drains you actually bank account. This is a step-by-step logic by why operating cash flow goes down under FIFO compared to LIFO. So lower cost of goods and your cost of goods is artificially low compared to today's market price. Higher taxable income, a lower COGS create a higher net income. A lower COGS net income makes sense karena sales COGS is something that we remove from the revenue or sales, the bottom line is the net income. Higher tax outflow. The government calculate your tax bill based on the big net income. Fuck! Okay, gue baca dulu terus gue istirahat. Higher tax outflow. The government calculates your tax bill based on what big net income. You end up paying more in actual cash taxes than a company using LIFO would. Reduce OCF because you send more cash to the tax office. Your operating cash flow. Because you send more cash to the tax office, your operating cash flow, the actual money left to run the business. Wait. I want to know what is the formula that connect operating cash flow and net income. OCF, right? Operating cash flow. Tax paid because the fucking because your net income is higher. Okay, yeah, it makes sense. Operating cash flow, net income, non-cash charges. Fuck, I forget the rest of the formula. Okay, let's take a break. 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Apa 17 dong, ngambil 18. Okay. Retain. What is retain? Working capital. I want to see as well if from I should take a break, but tapi gue pengen belajar. It's fine. If I'm a growing company, should I use FIFO or LIFO? And what does IFRS and US GAAP allow? the choice between FIFO and LIFO for a growing company usually comes down to a trade-off between looking good to investor or having more actual cash in the bank. The growth dilemma. If the goal is to attract investors slash IPO, FIFO, it produces higher net income and higher profit margin because use all cheap cost of good. It also makes your balance sheet look stronger with higher ending inventory. To fund expansion like cash is king, it produces high operating cash flow. What do this not allow? I know like IFRS only FIFO. LIFO is prohibited under IFRS. You cannot use LIFO. IFRS requires an inventory reflect more logical flow of goods or weighted average. Okay, we have WAC is also allowed in IFRS. LIFO is allowed. The LIFO conformity rule. If a company uses LIFO for tax purposes to have safe cash, US GAAP will require them to also use LIFO for their financial reporting. They cannot have their cake and eat it too. Okay. Okay.
Passing through the cool of the sidewalk mist. Although the Mizumaki also had a new get the heat is gone. The vision is fresh. Floating in the gray.
Midnight Pretender.
Evaporation of the urban fever 動かないままでたら関する環境の慈しみ
Ngerjain skripsi pakai lagu ini berselagi peristiwa yang telah menjadi sejarah.
Wet concrete smelling like a summer rain 濡れた地面が放つ雨上がりの錯覚 It's not a service, it's a small mercy
不要な苛立ちを排水溝へ流し ただ程度もされた涼しさを深く吸い込む Hey, passing through the cool of the sidewalk mist 音の水巻きを素肌に受けて The heat is gone
Okay, stop reading this. Come on, take a break first.
Droplets dancing on the green leaves 植え込みに宿る死にこの朝露の輝き Is there a soul in the rubber hose ただ潤すという素朴な答えが自分という渇きを静かに癒していく
The mist is gone, the day goes on 明日という高熱を一度だけ連結して Deep in the moisture of the shared street し口が湿られ水音がゆっくりと遠ざかる湿ったアスファルトに自分の靴跡だけが点々と残る
Let's go! Okay. LIFO versus VIBO in inflationary environment. The quick... What's CR? What's actually... current ratio, I'm pretty sure, right? I think somewhere here. Current ratio. There you go. Yeah, it's current ratio. Current ratio is current asset divided by current liabilities. Big. Because asset is higher. No, because asset is... Oh yeah, because GeoGuess gets lower, definitely, but because of that, asset is higher than it actually is, right? So that's why the current ratio CA divided by CL, current asset divided by current liability is actually get bigger because asset get bigger. And what the fuck is WASIT? WASIT anjing. We see is divided by current asset by current liability. working capital represent working calculate a current asset. And it's just backward. Okay, it's very simple. FIFO sales divided by COGS got small because COGS got smaller. Yeah, that. Yeah, the net income is going to be bigger in the sales. I'm going to the COGS. COGS get lower in the FIFO. Okay, profitability ratio and inventory method. LIFO is a better measure compared to FIFO of economic cost is in the income statement. COGS based on the statement. Assuming inflation, LIFO produce higher crucial. LIFO is better measure of economic costs in the income statement. That doesn't make any sense. Why does it see? Wait, how? I need to go to the toilet, bro. Fuck. Oke, gua post dah sekalian. Oke.
Droplets sliding down the metallic frame 骨組みを伝う雨水の規則的な落下 It's not an intrusion, it's a silent rescue 不要な壁を湿度の中に溶かしただ差し出された持ち手の角度を噛みしめる Dancing under the rhythm of the shed umbrella 雨傘の共鳴をステップに変えて The rhythm is wet, the soul is dry 不機嫌な天候をメロディーに乗せ Cruising through the grace of the rainy street Water puddles reflecting the two silhouettes 水たまりに映る重なり合った影 Is there a shelter in the simple gesture ただ隣を歩くというその選択が自分という孤独を静かに温めてゆく改札で壊した最後の一ペンそういう感謝の連鎖を次の代
Wait, so in the income statement, LIFO is better. What?
すれ違う瞬間に交わした無言の固定 Wait a little shit for a second 急ぎ足の靴音が不意に揺らぐ見知らぬ誰かの時間を守る配慮自分もまた別の入り口で救われ循環するマナーを体になじませる
Echoes of footsteps in the tile passage tiredに響く
Kalau Livo naikin cost of goods sold kan, makanya untuk turnover naik. Low days inventory on hand, high than bit. Can you give me an example of slide 13? Okay. Can you give me an example of using the formula on slide 13? So we have a beginning inventory of 150,000 and ending inventory of 20,000. So this is beginning and the end of 250 and the cost of goods sold is equals to 1.2 mil. Okay, so average inventory. While a high turnover is usually good, if it's too high, the company might be losing sales because they don't have enough stocks per customer. Finished good versus sales. If you see finished good inventory, you're going faster than sell. It is a red flag that determines that demand is dropping and write-down might be coming soon. Finished good. If you see finished good inventory growing faster, I wanna I want a perspective for value investing and growth investing about using perspective for value investing but using FIFO for inventory. For picking company to invest about using FIFO for inventory. It's not the best English. That was the right kind, but should be fine. I want a perspective for value investing and growth investing for picking company to invest. What using FIFO? Not the best English sentence that I create, but choosing between FIFO or LIFO is really just, but accounting is a strategic signal to the market. Yeah, that's what I was thinking, man. For the growth investor line, FIFO lean. The growth investor typically earning momentum and expanding margin. In the pyramid, FIFO is the glamour method. Net income boost. FIFO uses older, cheaper inventory cost of goods, which result in a higher margin expected because geogas is lower, the company support high gross operating margins.
Traffic light changes, but the feeling stays. 明日という速度を一度だけ落として floating in the echo of a small kindness 無垢なつながりに背中を預ける
Regardless of your investing style, you must watch out for LIFO liquidation. This occurs when a company stops.
最後の手振りが視界の端で温かく残る
What is this? Red flag LIFO liquidation. Can you give me example of LIFO liquidation?
A transparent shelter for the next sudden cloud 持ち手に巻かれた目印の相手間に合わせの優しさがつなぐずぶ濡れの回避 Anonymous shield against the liquid sky 駅までの数分を救い出す忘れ物名前も知らない誰かの余白に寄り添う Arrhythmia drops hidden the plastic sheet ビニールを打つ音色が告げる連鎖の終わり It's not a loss, it's a function of legacy 不要な見栄を雨しビルの中に逃がしてただ借り物の屋根の下で人をきつく The rain is stopped, the gate is dropped 明日という晴天を一度だけ待ちわびて Floating in the echo of the shed final Holding the rib of the left umbrella 残された傘に呼吸を預け The sound is wet, the soul is dry 不機嫌な夕暮れをメロディーに変え Sailing through the nostalgia of the sudden shower Water pooling in the folds of the fabric 畳んだ後に滴る誰かの時間の後 Is there a soul in the rusty spring ただそこにあったという救済の形が冷え切った指先を静かに温める Holding the rib of the left umbrella 残された傘に呼吸を預け The sound is wet, the soul is dry 不機嫌な夕暮れをメロディーに変え Sailing through the nostalgia of the sudden shower 立てかけられた一本の傘が次の雨を待ち構える雲の切れ間から差し込む光が水たまりを静かに照らす
The fuck is this song?
Rustling of leaves in the noon breeze ベンチに落ちる木漏れ日のバイブレ模様 A natural shelter from the direct sun Resting in the shade of the park canopy 公園の木陰で意識をにゃるめ The light is filtered, the air is cool 不器用な直射をメロディーに変え Drifting in the green sea of the urban oasis Yeah, 誰かが植えたちこの数十年の重みで葉を広げてで程度もされる無償の鈴 Shared oxygen of the old guardians 動かないままで享受する放題な余白意味を持たない緑のさざめきに同調する Yeah, empty bench waiting for
Okay.
the next one that I pen
8 minutes.
It's not a gift, it's a fundamental grace. 不必要な理屈を土の中へ返しただそこに座れる行く事実を噛みしめる Resting in the shade of the park canopy 公園の木陰で意識を緩め The light is filtered, the air is cool 不器用な直射をメロディに変え Drifting in the green sea of the urban oasis Oh yeah Distant sound of children playing in the sand 砂場で響く無邪気な笑い声の破片 Is there a peace in the midday sun ただ健やかに過ぎるという景色の一部が自分という歪みを平坦に整えていく The wind is soft, the thoughts are aloft 明日という距離を一度だけ調整して Deep in
Wait.
the rustle of the
Okay. I've read the material. Let's read it everything. I cannot show you. I can show you the okay. A consumer electronics retailer reporting under IFRS has a batch of premium headphones in inventory. The original cost, I'm just gonna write it myself. Original cost of $320. The current estimated selling price, I'm gonna put current price. The current price is 300. And estimated selling cost, and selling cost, it's $15 per unit. Okay, what is the carrying value of this inventory per unit on the balance sheet? It's 285. A furniture manufacturer reporting under USGAAP has inventory with original costs of $150 per unit. The current replacement cost, replacement cost is $125 per unit. The estimated selling price, the selling price is going to be $160 per unit. Estimated selling cost is gonna be $20 per unit, and normal profit margin is gonna be $25. What is the carrying value of this inventory per unit? Because this is under US. The first one is IFRS, the second one is US.GAAP. We need to calculate the net receivable value, right? So NRV is equal to selling price, which is $60, minus $20, so that's $140, right? Carrying value of this inventory per unit, 140. So that means it's between 140 and 115, and the replacement cost is 125. So I'm pretty sure it's 115 plus 125 plus 140 divided by 3. So let me just this out. 115 plus 125, 140 divided by 3. It's 126. I'm wrong there.
Trace the warmth on the polished slats 誰かが去った後のわずかな温度の余韻 A collective seat in the station hall 値木材が受け止めていた重みの記憶次に座る誰かへと引き継がれる休息 Physical inheritance of the public chair 動かないままで享受するつかの間のシェイシェコートの中に見つけた自分だけの座標 Resting on the rhythm of the wooden bench ベンチの余熱をビートに重ね The grain is smooth, the spirit is calm 不特定なつながりを安心に変え Waiting for the
Oh yeah, because this is the last one, so it doesn't matter the time. It's gonna be the
layers of time said he hit the hajit
moment the timer is off because this is the last time we're gonna do this. So I'm gonna do this.
背もたれに預けただ支えられているという事実に安堵する Resting on the rhythm of the wooden bench ベンチの余熱をビートに重ね The grain is smooth, the spirit is calm 不特定なつながりを安心に変え Waiting for the transit of the heart The train arrives, the rest survives 明日というプラットフォームを一度だけ離れて Floating in the silence of the waiting room Resting on the rhythm of the wooden bench ベンチの余熱をビートに重ね The grain is smooth, the spirit is calm 不特定なつながりを
Lower of cost or market. The market value in the placement is 125.
立ち上がった後に
Yeah.
残る自分
Because it falls between the ceiling and the floor.
次の誰か
Since the market is lower than the cost, the inventory is written down. Okay. If a company previously written down inventory subsequent recover in value, how should this? If a company previously written down inventory subsequently recovers in value, how should this event be treated under IFRS? The inventory cannot be written up. Reversal IFRS can be written up. Inventories can be written up to the new market, and the gain is recognized in other comprehensive income. The inventory can be written up, but the new carrying value cannot exceed the original cost. That's the most. The inventory can be written up without the the inventory can be written up. It depends on some of the market exam, but yeah, most probably don't. The inventory can be written up to the new market value, and the gain is recognized in the other comprehensive income. Definitely not. It's like a new line or a cost of goods sold. So it's assuming a company reports an inventory write-down as a part of cost of goods. What is the immediate effect of this write-down of a company? Assuming a company report an inventory write-down, okay, as part of the cost of goods sold, what is the immediate effect on the write-down on current ratio and inventory turnover rate? Current ratio doesn't change anything because it's cash, market securities, and blah 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 divided by current liabilities. So current ratio unaffected, inventory turnover decrease. But inventory turnover is cost of goods sold gets lower, so yeah, it's okay. Let's quick ratio, not current ratio. Okay. During the period of steadily rising price and stable inventory quantities, a company using LIFO valuation method compared to analytical FIFO will most likely report FIFO LIFO. No, LIFO is lower net income and but higher operating costs. No, harus sama. So higher net income and higher operating cash flow. So it's higher cost of goods sold. Okay. In inflationary environment, which inventory cost flow method provide most accurate representation of current economic costs on the balance sheet? Most accurate, I think it's FIFO. Pretty sure. LIFO is much more economically benefit. An auto parts distributor reports beginning inventory of 500,000 and ending inventory of 700 for the year. The company cost of goods is 360. Okay, I need to calculate. Days on inventory, so we need to calculate inventory math way. Algebra. And 6. And I think 365 divided by 6, it's 60.8. So it's this. In a period of rising price, compared to a firm using FIFO and otherwise identical firm using LIFO, which will most likely report in a period of rising price, this is inflationary period, compared to a firm using FIFO and otherwise identical firm using LIFO. Oke, ingat, LIFO itu higher cost of goods sold and higher cash flow operating cash flow, OCF, right? Because cost of goods sold get higher, that means net income is lower, right? Because net income is lower, that means return on equity is lower. And also because cost of goods sold, that means the asset gets lower. That means return on asset gets lower. Okay? Debt to equity, which makes sense, that doesn't do anything, but equity goes down, so that's wrong. No, it's actually higher, so it's correct. Because that means debt to equity is higher, right? Basic math. Now, lower to debt to asset ratio, it doesn't matter. That means the debt to asset get higher as well because the asset is yang bawah, kecil atas makin besar. Apa sih the ratio sekarang? Lower debt to equity is a higher debt to equity. Okay. A company utilizing LIFO inventory method experienced LIFO liquidation during a period of steady inflation. What is the expected immediate impact on a company financial statement? So this is immediate, so taxes probably not that fast. Unchanged profit margins, as no, definitely not. Increase in gross profit margin, and a higher income taxes. Because we use LIFO, that means the cost of decrease in gross profit. Definitely, I'm pretty sure it's like a minimum requirement to reset, with increased gross profit and a higher income tax. Definitely, yeah. So it's yeah. Which of the following inventory valuation cost flow method is explicitly prohibited? Okay, IFRS you cannot probably go. Okay. Okay, I redeem myself. Salah 3. The H1.
Deep in the pulse of the chlorophyll, so watching the slip of the potted plant, touch you and only see what shit of any no set it. The growth is slow, the pieces grow. Futomain, I kiss it to Yasiragi Nikai. Drifting in the nostalgia of the shared garden.
Okay, IFRS is defined an RF. Yeah, we minimize. This is the carrying value. Recognized loss. So carrying value is minimum of the cost and NRV. Loss function. Recognized loss is the maximum 0 or the USGAP proposition. Step 1, we calculate the ceiling and we calculate the floor. NRV. Define the market value. The market value is strictly bounded. It is replacement cost unless RSC exceed. Show me the. Okay, it's done. Maybe average to be 7 out of 3. Could have been, if kalau gue lebih teliti gue bisa 8 atau 9. I don't like financial statements, so cool thing on my part that I got most of it correct. So yeah. Okay. I think that's it for the stream. I've learned almost everything for 2B. There's still like 3 more, so it's gonna be more streams soon. Thank you for watching. See you. Bye bye. It's been 2 hours.